This is an office building, a Class A tower in downtown Chicago. 42 floors of steel and glass that was worth $480 million in 2019. It had a prestigious address, blue-chip tenants, and a 94% occupancy rate. The kind of asset that banks competed to finance, that pension funds fought to own, that represented the pinnacle of commercial real estate investment. Last month, this building sold at auction for $127 million, a 74% loss. Not because the building collapsed, not because Chicago disappeared, because the tenants left, and they're not coming back. This is not one building. This is not even one city. This is the story of $31 trillion in global commercial real estate that was valued for a world that no longer exists. A world where workers commuted to offices 5 days a week, where retail stores anchored shopping malls, where the highest and best use of urban land was stacking humans in expensive buildings. That world ended in 2020. The valuations pretending it didn't end are still sitting on bank balance sheets. And when those valuations finally adjust to reality, the losses will be large enough to threaten the stability of the global banking system. Not might threaten, will threaten. The only question is whether the adjustment happens gradually, over years of managed decline, or suddenly, in a crisis that forces recognition of losses that banks have spent 4 years hiding. Here's what they're not telling you. Commercial real estate lending is the largest single asset class on American bank balance sheets. Larger than residential mortgages, larger than corporate loans, larger than consumer credit. U.S. banks hold $2.9 trillion in commercial real estate loans, roughly 23% of all bank lending. Add the exposure held by insurance companies, pension funds, and the commercial mortgage-backed securities market, and the total U.S. exposure exceeds $5.7 trillion. Globally, commercial real estate debt totals $31 trillion. That's banks in Europe financing office towers in Frankfurt, banks in Japan holding mortgages on shopping centers in Osaka, banks in Australia exposed to retail complexes in Sydney. The same pandemic that emptied American offices emptied offices worldwide. The same e-commerce revolution that killed American malls killed malls everywhere. The problem is planetary. But the losses haven't been recognized because accounting rules allow banks to pretend the problem doesn't exist, as long as borrowers keep paying. Here's how the pretense works. A bank made a $100 million loan on an office building in 2019 when the building was worth $130 million. The loan was 77% of value, conservative, safe, well within underwriting standards. The borrower has never missed a payment. The loan is classified as performing. Today, that building is worth $60 million. The loan is now 167% of value, deeply underwater, hopelessly impaired. If the borrower stopped paying tomorrow and the bank had to foreclose, they'd recover $60 million on a $100 million loan, a $40 million loss. But the borrower hasn't stopped paying. The loan is still performing. Under current accounting rules, the bank doesn't have to recognize the loss. They can carry the loan at $100 million on their books, report their capital ratios as if the loan were fully collectible, and pay dividends and bonuses as if everything were fine. The loss is real. The recognition is deferred, and the deferral continues until something forces acknowledgement. A refinancing that fails, a maturity that can't be extended, a borrower who finally surrenders the keys. $1.5 trillion in commercial real estate loans mature in 2025 and 2026. $1.5 trillion in loans that must either be repaid, refinanced, or defaulted. For properties that were financed at 2019 valuations, refinancing at 2026 valuations often isn't possible. The loan amount exceeds the property value. No rational lender will write that loan. The borrower must either inject equity they don't have or hand the keys to the bank. The keys are coming. This is where the lie becomes unsustainable. To understand why the maturity wall threatens the banking system, you need to understand who owns this debt and how concentrated the exposure is. Commercial real estate lending isn't distributed evenly across the banking system. It's concentrated in regional and community banks, the 4,500 smaller institutions that dot the American landscape and serve local businesses and depositors. Banks with less than $100 billion in assets hold 67% of all commercial real estate loans. For many of these banks, CRE represents 40%, 50%, even 60% of their total loan portfolio. They didn't diversify because their communities needed commercial real estate financing, and that's what community banks do. They served their markets. Now their markets are destroying them. At 2:30 p.m. Eastern on Wednesday, the Federal Reserve released its quarterly Senior Loan Officer Survey. The survey asks banks about their lending standards and their assessment of credit quality. On commercial real estate, the results were the worst since the survey began tracking the category in 1990. 47% of banks reported tightening standards on CRE loans, not making new loans easier, making them harder. 63% reported weaker demand for CRE loans. Borrowers aren't even trying because they know they'll be rejected. 31% reported that CRE loan quality had deteriorated over the past quarter. Loans they already made are going bad. These aren't lagging indicators. These are current conditions. Banks are telling the Fed, on the record, that their commercial real estate portfolios are deteriorating right now, that they're pulling back from new lending right now, that the losses they've been deferring are starting to arrive right now. The problem is that pulling back from new lending accelerates the deterioration. When banks stop making CRE loans, property owners can't refinance maturing debt. When they can't refinance, they default. When they default, banks take losses. When banks take losses, they tighten lending further. Another doom loop, running through the heart of the American banking system. When regional banks fail, the damage doesn't stay regional. We learned this lesson in March 2023 when Silicon Valley Bank collapsed in 48 hours. SVB wasn't a real estate bank. It failed because of interest rate risk on its bond portfolio. But the failure triggered a run on regional banks nationwide. Signature Bank failed. First Republic failed. PacWest, Western Alliance, and a dozen others saw deposit flights that required emergency Fed intervention to stabilize. The regional banking system survived 2023 because the failures were concentrated in a few institutions with idiosyncratic problems. SVB had a concentrated depositor base of tech startups. Signature had crypto exposure. First Republic had wealthy clients who exceeded deposit insurance limits. Commercial real estate is not idiosyncratic. Every regional bank has it. The exposure isn't concentrated in a few institutions. It's distributed across thousands of them. When CRE losses materialize, they'll materialize everywhere simultaneously. The Fed can't bail out 4,500 banks. The FDIC can't manage 500 resolutions at once. The system isn't designed for a systemic shock to the asset class that regional banks depend on. At 7:15 a.m. Eastern on Thursday, Moody's downgraded 6 regional banks, citing elevated commercial real estate exposure and deteriorating credit quality. The banks were Zions Bancorp, Comerica, U.S. Bancorp's Regional Lending Unit, KeyCorp, Huntington Bankshares, and First Horizon. Combined, these institutions hold $147 billion in CRE loans. Downgrades raise funding costs, which pressure profitability, which reduces the cushion available to absorb losses. The downgrades aren't causing the problem. They're recognizing a problem that already exists and making it marginally worse. Each downgrade makes the next one more likely as the entire sector reprices. Less than 90 days remain before Q1 2026 earnings season begins. In those earnings calls, banks must disclose updated assessments of their CRE portfolios. They must report non-performing loan ratios, charge-off rates, and reserve levels. The numbers they report will either confirm that the deterioration is managed or reveal that it's accelerating beyond their ability to absorb. The early signals suggest acceleration. In Q4 2025, CRE charge-offs at regional banks increased 47% quarter over quarter. Non-performing CRE loans increased 34%. These aren't small movements in stable categories. These are rates of change that, if sustained, overwhelm capital buffers within 18 months. While one side extends and pretends, the other side calculates. The largest banks, JP Morgan, Bank of America, Wells Fargo, Citigroup, have commercial real estate exposure too. But their CRE portfolios are smaller relative to total assets, more diversified geographically, and better reserved against losses. They can absorb a CRE downturn. What they can't absorb is the contagion that spreads when regional banks start failing. The big banks are counterparties to the regional banks in dozens of ways. They provide correspondent banking services. They participate in syndicated loans. They trade securities with regional bank portfolios. They clear transactions through interbank networks that assume all participants are solvent. When a regional bank fails, the big banks don't just watch from the sidelines. They're in the middle of the unwinding, facing claims, calculating exposures, managing risks they didn't know they had until the failure revealed them. The interconnections that make modern banking efficient also make it fragile. At 4:45 p.m. New York time on Friday, Bloomberg reported that JP Morgan's Risk Committee had requested enhanced monitoring of counterparty exposures to regional banks with CRE concentrations above 300% of capital. 300%. $3 of CRE loans for every dollar of equity. That's the threshold JP Morgan's risk models have identified as concerning. Of the 4,500 regional and community banks in America, 1,847 exceed that threshold, nearly half. JP Morgan is mapping their exposures to banks that their own models say are at risk. When the biggest bank in America starts tracking which smaller banks might fail, that's not paranoia, that's preparation. This is what a systemic risk looks like before it becomes a systemic crisis. The losses exist. The accounting hasn't recognized them. The maturities are coming that will force recognition. The institutions holding the losses are concentrated in a segment of the banking system that cannot absorb them simultaneously. The larger banks are preparing for contagion, while publicly reassuring markets that everything is fine. The office building in Chicago lost 74% of its value. Multiply that by thousands of buildings in thousands of cities. Multiply by the trillions in loans made against those buildings. Discount for better properties in better locations that haven't fallen as much. Add back the worst properties in worse locations that have fallen more. The aggregate loss is somewhere between $500 billion and $1.2 trillion, depending on assumptions. The banking system's total capital is $2.3 trillion. A $500 billion loss is survivable. A $1.2 trillion loss is not. The range between those numbers, between bad and catastrophic, is where the uncertainty lies. Some will look at the commercial real estate problem and see gradual adjustment. We'll trust that banks are reserving appropriately. We'll assume that extend and pretend works indefinitely, that borrowers will keep paying, that tenants will return to offices, that retail will recover, that the 2019 world is coming back. These are the same voices that said subprime mortgages were contained in 2007, that said the housing problem was regional, not national, that said bank exposure was manageable because the loans were performing. The loans were performing right up until they weren't. The losses were hidden right up until they weren't. The system was stable right up until it collapsed. Others will read the Fed's surveys. We'll track the charge-off trends. We'll count the $1.5 trillion in maturities coming due this year and next. We'll notice that 1,847 banks exceed the concentration thresholds that JP Morgan's risk models flag as dangerous. The informed are not predicting which banks will fail or when the crisis will arrive. Predictions require certainty that doesn't exist when accounting rules allow unlimited deferral of loss recognition. What the informed recognize is that the losses are real, the exposures are concentrated, the maturities are arriving, and the system designed to handle bank failures cannot handle failures at the scale the math implies. This is not financial advice. This is not a recommendation to sell bank stocks or withdraw deposits or take any position based on commercial real estate exposure. This is simply an observation about what happens when $31 trillion in real estate was financed for one world and must be valued in another. The office building in Chicago still stands. The lights still work. The elevators still run. From the street, it looks exactly like it did when it was worth $480 million. But the tenants are gone. The value is gone. And the loan made against that building, the loan still carried at full value on some bank's balance sheet, represents a loss that hasn't been recognized but cannot be avoided. $31 trillion in commercial real estate, $1.5 trillion in maturities, 1,847 banks above danger thresholds, 90 days until earnings reveal what the balance sheets are hiding. The mistake was made years ago, when banks financed a world that was about to change. The reckoning was deferred, quarter after quarter, through accounting flexibility and regulatory forbearance. But deferrals have limits, maturities arrive, reality asserts itself, and $31 trillion in commercial real estate is about to discover what it's actually worth, whether the banks holding the loans are ready to find out or not.